Okay, so today, what I really wanted to share is a strategy that I've been working on not too long, probably a couple of months, and I call it the delta neutral strategy. So it really, um, and we'll get into it more, but it's trying to set up a strategy where we don't really care which way the market goes, and it's an income generating strategy, and you can we'll learn a lot more about it, but there's lots of different variations. This is just one that I've been trying on, so you guys could probably take it home, tweak it to something that fits you, but I think it's a pretty interesting strategy. So get to the next slide. Okay, so the agenda. What I want to talk about is, let's define the strategy, what it is, what the trade is trying to accomplish, when is a good time to trade, and then more importantly, what are the trade mechanics and trade management? And then, like some people have already mentioned, what are the variations to this trade? And Dennis is in here with me, and we've already kicked around multiple variations already. So it's an interesting strategy in that the main concept is pretty steady, but the alternatives are pretty, you can vary it. So here's the strategy. We are looking to buy an at the money call and an at the money put. And this says we're using somewhere from 90 to 120 days. So, and the reason we're going out that far is really just to minimize the effect of theta. So we're buying the call and we're buying right at the money for both strikes. Same strike price. And then we are selling weekly calls and weekly puts against it every week. And the goal when I first started out was to collect 1% in premium every week. So, and I'll show you kind of how that works in terms of what strikes to sell and things like that. I have my laptop, my program up. So once we get down to the nuts and bolts, we can bring up the computer and and play around with different strikes and what the prices are. So anyway, so just to recap so far, we are looking to buy the at the money call and the at the money put. So, and one of the things we'll see later is in the variations, there could be some tweaks to that. And we sell weekly calls against it. And again, that's another variation, selling shorter or even longer than weekly. And then the goal is to generate 1% a week in premium. So how's that sound so far? Good. And then what the other piece of this is, we want to keep it a delta neutral strategy, right? So as the price of the whatever we're selling it on, we have to recenter our strikes. So as the price moves up or down, we readjust so we're back to delta neutral. So, and I on the SPY, just as a example, if it moves 5 points beyond my strike, I recenter. So I use 5 points on the SPY. So you could use 50 on SPX. And that's, you could tweak that any way you want, but that way it remains delta neutral. Because if you just leave it and you put it on in 30 days, the market has gone up 5%, then you're not delta neutral. And then the last piece is we generally want to close this trade as we get to about 60 days prior to expiration. So put it on 90 to 120 days, sell calls and puts against it all the way through, and then we close it and start a new one.
So if you're starting with a 90 days, that means typically we get 4 weeks and then you close it.
Right. You could do, if you did 90 days, you would want to close it after, 1 month. Yeah. So, and I've kind of played around. I've done like 105 days and, but the further you go out, the more you pay, but the more time you have to write calls and the less data. So that's it's kind of a tricky piece in terms of, what's the ideal. So the thing I'm doing is kind of playing around with it. So, and we'll talk probably a lot more in the variation. So let me just see if there's any questions from our visitors. Yeah, so Mark just captured it. 50 points for SPX for adjusting, 5 points for SPY. That's what I use. And so I hope that at least, and we'll get into that more later. What I would do is I will close out the long and start a new one. So any questions? Dan, any questions?
No, could you repeat all that?
Yes, I can.
Record it so you can go ahead.
I am recording it. So, hey, Miss Glenna. Okay, so that's the basic strategy. So it's pretty simple, right? We buy at the money, we sell weekly calls against it. And so that's what I really like about it. It's just a simple, neutral strategy. So, okay, so here's what we're trying to accomplish. We are trying to generate income off our long options, regardless of which way the market moves. Now, after last week, we all know which way the market's moving, right? It's never going back down again. So that may be true, maybe not. But what we will see is, the market's going to fluctuate up and down. And what this strategy does, it keeps you out of, on a day where the market is down 1%. This particular trade is awesome. It doesn't move. Your puts are making money to offset the cost. So that's kind of the beauty of the strategy. And it's one of those ones you could put it on and just look at it once a week if you had to. And then, so in terms of what I do personally, I trade the SPY. I've started with the SPY. I will probably switch to SPX shortly. And the reason I like SPY is they have great liquidity. You never have to worry about, are you going to get filled? They offer a lot of nice strikes, a dollar-wide strike, so you don't have to go, oh, I got to go $5 or whatever. And the other thing is they offer daily options. So sometimes when I'm making an adjustment, if I'm like 3 days into my weekly and I'm already at a full profit, I can roll that out another 7 days to like midweek. So that's kind of the nice thing about having lots of options. And then you don't have to worry about earnings. So if you have, if you're doing this on a NVIDIA or Tesla or Netflix, one, you don't have daily options, but two, you have to be out before earnings. So using SPY is kind of my first start at this strategy. I want to trade SPY, and then eventually I want to trade it on SPX once I kind of ramp up the number of contracts. But it can be used on pretty much any stock, index, even the futures. So you can go out and buy whatever you want to trade calls against, and any of these will work. I'm just going to mainly talk about the S&P right now. So any questions? That makes sense? Okay. So let me see if there's any questions in the group here. Okay, yeah, that's a great point. Okay, so SPX or any of the cash index, NDX, SPX, has tremendous tax advantages. I'm not a tax person, but there's a provision in the IRS that treats SPX, even though you trade it 0 day, 1 day, you get treated as 60% long-term gains, 40% short-term gains. So big advantage there. So
That's only for the state, not for SPY. States, not for SPY.
no, not for SPY. Right. Because SPY is just a private ETF, but SPX, yes. So, and SPX is like 10 times the size of SPY. So just keep that in mind. It's a lot bigger. So that's the reason I'm starting with SPY, kind of ramping it up, ready to kind of dip my toe doing SPX now. So, and then, Terry asked, are we going to change the SPX for higher returns? Not necessarily higher percentage returns, but higher, income, investing more, making more kind of thing. Hope that answers your question, Terry. So, okay, so that's what we're trying to accomplish. We're mainly trying to get income, but I think one of the other questions is, do you ever make money on the long calls? And you actually do when you recenter the strikes, and I'll show you that. Okay, so when is the best time to do this trade? And the good thing is you want to make sure you want to do this trade when the volatility is low. So, I don't know if you guys noticed, but I've been waiting to put on a new delta neutral trade before the election. I said, well, you could put one on before the election, but the IV was like 20. And so if you are buying it when the IV is high, you're paying a lot for those calls and puts. So right after the election, IV dropped like 25%. It went from 20 to 15. So I was really excited and said, I'm putting a new delta neutral trade on. So you want to put this trade on when the IV is low. And you can look at VIX as your main indicator, because you want to make sure that if the VIX is over 20, you want to wait. You don't want to put the trade on. But it's down about 15, 16 now, which is like the perfect time. So that's one thing that I look at, and it enables you to pay a lot less for those strikes. And then also the other thing is, when IV does increase, and it will, those options are going to be worth more money. So it's kind of a double-edged thing. You get it cheap, and when it goes back up, you make money. So does that make sense, everybody? Okay. And then the other thing is, you want to put this on after a risk-on event, like the elections. That was a big deal in terms of risk, right? It could have, I don't know if y'all remember, but when, I think it was in 2016, overnight futures went up and down like 1,000 points, up and down. It was crazy. So it didn't happen this time, but who knew, right? So you want to avoid putting it on before like a big known event. And also, I would probably say, if you're in this kind of a trade and something big is coming up, I mean, like maybe there is a potential war or things like that, you probably want to go flat. You don't want to hold it through a major event like that. And then in terms of when you sell, it really doesn't matter when you're selling your puts and calls. I try to do them after that morning chaos, the first half hour or so before I would sell a new call, and tend to do it late, maybe right before lunchtime. And it doesn't, in this particular thing, it doesn't really matter too much. And then the other piece is when you want to make adjustments to your short strikes, like say you sold a 600 on the SPY for the call, and now the market is getting right up to 600. And you're saying, what do I do? When do I roll it? I tend to wait till around 3 o'clock before I would roll it, Because a lot of times what will happen is it'll move all day up to that 600. And then about, kind of towards the end of the afternoon, there might be a pullback. So you don't want to kind of pull the trigger too early on adjusting your short calls. And generally, we're going to sell them far enough away that we don't have to do adjustments. So that is that. And let me check for questions. Yeah, so a question that Gene asked was, is it better to sell short options when the IV is high? Yeah, that's definitely true. However, we're paying a lot of money for these long calls. So in terms of when we get in, we want it to be the low time. The ideal thing is we get in when the IV is at 15, the IV goes up to 18, and we're selling calls against it. So, we don't hope it stays down. We hope we get it when it's low and then it goes back up to normal. So great question. Okay, so any questions on terms of the timing? Is that pretty straightforward? Okay. So this is just a graph of the VIX chart print. So you can see where right before the election here, how high the IV had gotten. You see that? So I kept saying, like, I'm going to wait until IV gets under 18. Because if it's, and I just drew like a random line at around 18. That's kind of the average where it's been over this period of time. So my thought was, well, if it gets below that line, that's a perfect time to enter and get into a delta neutral trade. Not like up here. Up here is not where you want to get into a delta neutral trade. Even here, because at this point, this green line here, we didn't know if it was going to keep going up, right? So this is kind of like below this line is kind of an ideal time to enter a delta neutral trade. Make sense so far? Okay. So here is the trade mechanics and the trade management. Again, it's nothing too complicated. We begin when we buy our long strikes. So we are looking, and it's real simple. We're looking for where is the index trading right now. That's where we're buying a call and buying a put. So if the SPY is at 600, we're buying the 600 call and the 600 put. And we go out again about 90 to 120 days. And the goal is we want to minimize theta. That's why we're going out that far. And I like to buy the monthly options when I'm buying my long calls because they have the most volume, the best bid-ask spreads. And so I always just say, what monthly strike am I going to use? So that's kind of my goal. And, that's just the way I do it. You could do it any way you want, but I just find that it's easier just to say, I know I have the December options or I have the February options. And then every week, I try to sell the Friday expiration. Mainly because it's just easy to remember, right? On Friday, it looks like, where the strike is relative to the where the stock is trading. So if you do a Thursday expiration, for example, then you're going, oh God, I forgot it's Thursday, my options expired. So I try to start out using the Friday expiration. So that's kind of my the way I do it. And what I look to do is sell the call, and I meant sell the call and the put about right outside the expected move, like 1.5 times to 2 times the expected move. So if you look on the option chain, it'll say, the expected move is 5 points. So I want to sell somewhere, 7, 8, 10 points out of the money. That way, if we get a massive run, I'm not in the money. So that's kind of the reason I do that.
So do you have a delta rule for that? I mean, like, do you just go for like 15 delta so that it's gonna?
You know what? I focus more on the distance, but they tend to generally be around 20 to 25 delta in that range. And then within that, I'm looking to see, okay, which strikes here have the best liquidity. So I might scooch it up a little bit or back if one has all the liquidity. It's amazing if you look, even on SPY, there'll be a strike that has 200 open contracts and one that has 2,000, 1 point difference. A lot of times it's a 5 or a 0, right? Like 595, 605, 610. Those are where you're going to have your most liquidity. So, so that's what I look to sell. And then I will sell a call, adjust if that leg is challenged. And what I will generally do is either roll it out. That's basically what I'll do is roll it out. But if you sell it far enough out, you don't have to worry about that quite as much. Yes.
So I know you said that 1.5 to 2 times expected move with the option change. Do you use the ATR as well?
I don't use the ATR, but it's probably not a bad idea. I mean, anything that you can use that just kind of makes it more mechanical, you know, like right. Because what the goal is, you want to try to get the maximum amount of credit, but not be too greedy or too conservative. So it's kind of an art that you want to play with in terms of what calls and puts you want to sell. I mean, the ideal thing on a SPY, if you sold the 600, you want it to finish at like 599.75, because that's perfect. You know what I mean? And if you sold the 605, you're going, oh, I left money on the table. But you sleep at night better, right? So that's kind of the trade-off. And so Mark asked if 1.5 times the expected move gets 15. That's been my experience, you know, that how far out you have to move, and that's what the premium, the deltas are. So so again, just I buy the strikes at the money, sell weekly calls against them, start selling the Friday expirations. I'm using, you know, that you know, expected move, how far out I want to go. And then you could also look at resistance and support levels. If there's a really, really strong resistance level, you might want to, you know, you want to be above that and below support level. So you want to make sure you're thinking through what's the ideal strike. And you're going to be wrong some of the time. But most of the time, if you use these kind of guidelines, you're going to be fine. They'll expire and you can sell a new one the next week. And then so the next point is recentering. So if I bought the 580 put in the 580 call, and now the stock has moved, the price of SPY has moved to 595. I want to roll both of my calls and puts up to that level. I don't want to change the expiration date. I want to keep the same. I just want to, you know, push them higher. So I use Tastyworks. So all you have to do is say roll strikes up or down. You roll them up. It shows you where to, you know, how to do it. And what you're going to find is one of those rolls is going to give you a credit, and the other one's a debit. And hopefully it's a net credit. So, and I use 5 points. So every 5 points it moves, I'm going to be looking to recenter. I would tend to do it kind of towards the end of the day, because, you know, if it runs up 5 points and then all afternoon it sells off, then you kind of like you've done it too early. But so yeah, I'll tend to wait till the end of the day to recenter. And then the other thing that can happen is if you sold a strike and the price really moved beyond your short call or your short put, probably want to close that trade out. And what'll happen is it's still going to be profitable because the price of your long call will have paid for, you know, that move. And so you don't want to end up being in the money on your short call or your short put. So you either roll it or close the position. And I'll show you a couple examples where I've done that on actual trades. So let me see if there's any questions here. You guys have some great questions. So you see, so you're saying that when you readjust the long, you do the same short weeklies that are in play. Actually, what I think that's a great question Terry had is, if I adjust, say, the short call, do I automatically adjust the short put? And the answer is no. I'll look at them individually. And I have a couple of spreadsheets up that I'm going to show you in just a second that'll kind of point that out. So, okay. So any questions in here, guys? Glenna, is making sense? You like it?
Yeah.
Okay. I was talking to Glenna earlier this week and I said, I'm going to show you the delta neutrals trade. Okay. So that's the mechanics and the trade management at a really high level. So here is, I think this is my second one that I did. So can y'all read the numbers? Okay. So what I did is I created this little spreadsheet, and I'm not a spreadsheet person. So, but what I did is I said, okay, I started this trade on 9:30. And you can see the price of the SPY. Whoop, oh no. Let me see if I can get that back. Sorry about that. Okay, back. I won't touch it anymore. So I bought the SPY was at 571.80. I bought the 572 put and call, and I went out to February of next year. And then, so I paid for the long call and the long put $46. Everybody see that? Okay. So I wrote calls and puts against it. So in a negative would be a credit, positive is a debit. So it got down to on October 11th, and I recentered my strikes. Y'all see that? So on the 11th, I rolled my call from 572 up to 580, and my put from 572 to 580. So on the call, I received a credit of $5.58, and the put cost me $2.54. So it was a net credit to recenter the trade. Y'all see that? Okay, and then I rolled a couple of times because this is, you know, when the market was really pushing higher. So, and then then it pulled down, so I recentered lower. You see, that went from a 580 down to a 470 and a 471. So on this one, I got paid $347 for the roll on the put. I paid $446 on the roll for the call. So a slight debit to recenter the strikes.
Why is it recentered to 571 and 573? They're two different.
Yeah, on that one, I just wanted to minimize how much it was costing me. So I kind of cheated a little bit. So yeah, and then when I rolled my short calls, I kind of made up for that anyway. So, and then, you know, I had more puts and call credit. Then the market went up after the election. So I rolled my calls up to 587, put and call, made like a $6 credit. And then I sold another put, recentered again for another credit. And so, so that is where we're at with the trade. So if you add up all the debits and credits, my cost basis in the trade is $27.51. And to exit the long strikes as of Friday, whenever I updated this, I would have collected $36 in credit. So it's about a 32% gain on the trade. Did I lose you? Okay.
The short calls I'm not following. The 9:30 long calls, the first one. And you did a short call at 583 and short put at 572.
Right.
So was it not the
money? Well, that's probably a typo. Yeah. Good catch. Because I would be, this like on the call was like 9 points above. It's probably, if I was going to guess, it probably was a 562. But anyway, so that trade is still open. So any questions about that? Let me check our online folks.
Your first, when you put it on with what, 571, so what was the expiration date on?
Yeah, great question. So yeah, so the $6,
I mean, that's not.
Yeah,
90,
yeah, on the first expiration would have been 10-4.
I think she's talking about the first long call.
Oh, the long call, I used 228.
That's for about 5 months.
Oh, I see.
Yeah, so, and then every time I recentered, you see I kept the 228 date. So that's how I can keep track of it. So, okay, so here's the this is the one I did after the election. Remember I said I wanted to see IV go down. So this is what I've done. So I did this on Wednesday. The S&P was 588.64. I said, we're running higher. So I actually sold the 5.9 or bought the 590 and the 590 call and 590 put. So I just scooted it up a bunch. And then I sold a 600 call and a 575 for the first week. And I had to, 2 days later, I recentered the position because it had moved up so much after the election. So my net credit of recentering it was about, I guess, about $1.50 in terms of credit. So I recentered to 595. I rolled my put and collected additional credit. So my original basis was 36.84. And right now it's around 37 to enter. So it's about a 14% gain in a couple of days. And, it probably won't keep going like that. I mean, that was a massive move after the election. But that's how you recenter the strikes, because if you just left that 590, you're out of sync, right? You're more bullish than bearish. So, and what happens is if the market pulls back, you've lost the gains on your long calls. So by recentering it, you kind of capture those gains. Dennis, any questions?
Nope.
Have I lost you? You're not reading yet.
Yeah, no,
Oh, so okay, so that's my second trade on that SPX thing. So so that is kind of the basis of the trade, and
but if we move to SPX, the fees will be much higher. Right? So how are we going to
they'll be higher, right? But if you were, say you were ramping up, like I'm doing 1 SPY, now I'm doing 3 SPYs, then that fees kind of offset each other. You know what I mean? A fees of 1 SPX is going to be less than 10 spies. So Kevin had a couple of questions. Make sure he says, I think I can't sell the identical strike on calls and puts. And you wouldn't be selling the same strike on, you're selling that out of the money call on your, but you're buying the same strike. And then, so you're buying the same strikes, you're selling different strikes. So, and then Jerry asked me, why did you sell the calls on the 13th? I guess that was on the original one. I think what I was trying to do was, I was in the middle of the week, so I just wanted to roll it up 7 days. So that's kind of my thought process there. And again, you can do that any way you want. You can just roll it to the next Friday if you want. But if I'm in the middle of the week and I'm rolling because I've already captured all the credit, I generally want to roll it out 7 days from there. So that's my method to my madness on this trade. So, okay. So let me get this. Okay. So, so here's the other piece that I think is really interesting. There's lots of different variations you can do with this trade. Instead of selling weeklies, you can go out further, say you want to go out a year and buy your calls and sell monthly calls against it. Sell monthly calls and puts against it. If that's more your style, it works the same way. The other thing that I'm actually looking at is selling daily options against the long call and long put every day. So that is, to me, that it just bodes to, a really, if I could say, safe way to trade zero DTEs. That's a pretty safe way to generate income selling zero DTEs. And so that is a couple, and we'll talk about that in just a second, but so that would be a couple of different strategies. You can also only do the call and the put side. It's no longer a delta neutral strategy, but you could say, I'm just going to buy the call at the money call, or even scoot it to an in the money call and sell daily, weekly calls against it. And so that's kind of another option. Let's see, you can do it on stocks. If you have a stock that generates great credit, you could do a delta neutral trade on any stock and collect credit on both ends. And by buying the call and buying the put, if it moves up or down, your loss is minimized. Does that make sense? And then, and you could do this on an index as well. You can do SPX, you can do NDX, you could even do it on the futures. So lots of different variations there. So let's see. Let me check on questions. Has this been helpful so far? Yeah, so can you do it on IWM? Yep, you can, pretty much any stock that has good liquidity and at least weekly options if you want to sell weekly. So if you have a favorite index, then you can do that. So, and the cost of these trades are pretty minimal. You could buy a SPY and do the trade for a pretty reasonable amount of money to get into the trade. Like an SPX probably costs you $25,000, $30,000 in terms of a trade. A SPY would cost you $2,500, $3,000. So they're pretty, very scalable, I guess. That's. Let's see. So those are some variations. The more I kind of kick this strategy around, the more I say, well, you could do it on this kind of thing. Lots of different options, but the main kind of point is this is building us a delta neutral strategy that generates income. So anything beyond that, it kind of morphs into whatever you want it to. And you can see by those early numbers, they're pretty good income. Let's see, I already saw that. Okay, here's the 0 DTE variation. So this is, I've done it one time in 0 DTE. So my thought is you could do it a number of different ways. If you're bullish right now, you can do it by buying the call and selling 0 DTE calls against it. If you're neutral, say you're like, I don't know which way it's going to go, you could do the true delta neutral and sell the put and the call. If you're bearish, say we're in a downtrend, you could do it, buy the put and sell puts against it. So that is my thoughts on a 0 DTE variation. Any questions about that? That make sense? Do you like it? So let me see if our visitors online have some questions. Okay. No, they didn't. Okay. Okay. So that would be, so here's my first and only 0 DTE SPX trade that I did, kind of using this. So on this, I did on SPY. Yeah. So on the 7th, I bought a 585 call that I went out 90 days. So I didn't go out as far. I think it was actually 85 days. But so I bought and it cost me $2,436, $24.36 per contract. So my first step was I sold the 597 call and the 599 call. So, and what happened was the price moved through my 599 call, at least in the afternoon. So I closed out the whole trade for $27.26. My cost of the trade was $23.66. So it was about a 15% return on risk in one day. So that was, that one needs a lot more work, but that's kind of the mechanics of setting up a 0 DTE on the SPY. And if you had done this on SPX, the cost would have been 10 times as high and the profit would have been 10 times as high. So I always want to start with the SPY while trying to test out a strategy. But that's kind of the mechanics of how you could do it on a 0 DTE. And one thing that I would say, I was talking to somebody and they said, they like the strategy, but they won't be able to go put a trade on when they go golfing all day. And I said, you absolutely don't want to put an option expiring that afternoon and be gone, go to Disney for the day or go golfing. You can leave the long call on, but you don't want to be selling a short call if you're not around to watch it.
Do you ever pre-place your exits on when you're doing your weeklies?
Yep. The question is, do I ever set a I don't. Do I set a?
You don't have to babysit it.
Yeah, you could. I mean, the problem I think is you'd have to set it up like as a bracket order.
Yeah.
You could, and
or well, not necessarily if you just.
You just have a stop loss or something. Yeah, you could. I haven't done it yet, but it's not I haven't done it all that long. So, and I tend to be in front of the computer most of the day. So, so I like to watch it, all day long. But But, so if I wasn't in front of the computer, I might tend to lean more towards the weeklies. Like if you were working a full-time job, you don't have to sweat it as much one day, right? Now, Thursday and Friday, you want to be watching it a lot closer. But Monday, if the stock moves up, you're probably going to be okay. You're not going to get a sign. But so the zero DTE, you either need to trade it on when you're going to be around, set a bracket order like you mentioned, or skip it that day if you're not going to be around.
So when the short calls are supposed to go in the money, you wait till the end of the week to see if it normalizes by the time and before you roll out the position, or you do it right then.
Okay, great question. The question was, well, what do you do if the stock, the price goes in the money? I don't tend to panic the minute it goes in the money, but if it's like trending, in the money, then what I probably end up doing is recentering my strikes and then adjusting the short strikes. Because like what'll happen is like the price moves up $5, right? Now my short call is getting threatened. But if I can recenter it, I can make a $3 net credit. I can adjust that call without taking a major loss. Does that make sense? Okay. So great question. But I wouldn't panic like the minute it hits my short call. I wanna.
Well, if it goes too deep in the money,
yeah, you don't want to like just ignore it. Like if you have the 600 and it's at 603, you don't want to do that because then you probably want to close the position out. The good thing is if you close the position out, you can put a new one on the next day. You know what I mean? It's not like you missed the boat kind of thing. So you can just do it that way as well. So that's my zero DTE experiment. And I'm going to probably keep working at that one because I think that there is a lot of potential there. I was looking at a number probably this morning, and I said, okay, if I went out and just did a delta neutral SPX, and I bought the 6,000, and I sold basically I went out further because I wanted to be a chicken. I sold a 15 delta on both sides. That would net me about 4% in a week in terms of credit and then weekly was like 1.5%. So pretty juicy premiums for either a week or even a day. So a couple of other questions here. You guys have great questions. Do I generally let the options expire at the end of the week or do I roll them sometimes? Yeah, I generally, about Thursday, if it expires Friday, about Friday, I'm thinking of rolling it. If it's down to like, if I've collected 90% of the credit, I want to roll it. But sometimes I'll wait longer, even though it's out of the money, maybe I got 40 cents and it's sitting at 15. Well, I want to wait longer till it gets down to the 50, where I've collected the whole credit. So that's probably where a lot of judgment comes in. Like if you want to like it's Friday and you don't want to watch it to see if something happens, that you can roll it out to the next Friday and then go to dinner or something. So let's see. And then recommend not doing zero DTE if you want to set it and forget it. Yeah, I would definitely not put a zero DTE on and not be in front of the computer. And I probably wouldn't set like a bracket order because sometimes at the end of the day, zero DTEs will give you some really crappy fills. So that's that. Let's see what else.
It's an interesting use of that strategy because you're basically applying long-term strategy.
It is.
Where I in my playbook, that's a volatility play. You know, so if you see consolidation on charts and whatever, because you know it's going to move up or down,
Mhm.
then you take advantage of that.
Right, right.
You know, so I've never thought to do a long-term one.
Yeah, and I'm not sure where I think it was actually a trader friend of mine that talked to me about this delta neutral strategy. And he was doing it on stocks and all kinds of stuff. And I'm way too big of a chicken to do it on Nvidia or Starbucks or anything other than SPY. And then, I think it was actually same trader guy, really good friend. He told me about an ETF that sells zero DTE on SPX and NDX. It's an ETF. And then so we dug in, we went to their website and we figured out how they were doing it. And my first thought was, heck, we could do that. That's kind of the zero DTE idea. It's buy the longer dated call and put, or just call or just put and sell the weeklies against it. So, and one of my thoughts was on that is if we're in a bullish trend, just sell the calls. If we've leveled off, do a delta neutral. If we're in a downtrend, just sell the puts. So I haven't gotten that far yet, but that's kind of my thinking on how I might do the 0 day.
I mean, it's kind of like a shorter term leap or a 4 minutes probably call. I mean,
It is. You're
just buying.
Yep. Yep. And I told you we wouldn't talk about that, but we did. No way. It really is a diagonal call and a diagonal put. So anyway.
So these long calls that you're doing for 90 to 100 days, will buy them individually? One long call and long put, will buy them individually, or do you bundle them together?
I usually buy them individually, but I buy them like one, then the other, kind of thing. I don't like try to time it. You could do it either way. I mean, you could just say, I'm going to buy the 600 put and call and pay, $25 and hit it and see if it fills. But
in case I roll out only one of them, would it make any difference?
Yeah, I try not to roll only one because I want to stay delta neutral. Now I did cheat a little bit, right? On that one, I rolled it within 2 points of each other. I cheated. But I should have kind of done the exact same one, but it worked out okay because like a few days later, I recentered it back to a delta neutral. So it's kind of a little bit like chess sometimes, right? Do I roll it? Do I hold it a little longer? But it's a great way to generate income. And I can tell you the couple of days that I had this where the market was up 1% or down, mainly down 1%, I looked at my long call and my long put and they offset each other. So I was like, I love this strategy. I wish my other ones had done the same thing. So that is the strategy. So any question, you guys have been great asking a lot of questions. I appreciate that. So that is the basic strategy. So any questions from you guys? Any feedback? Do y'all like it? Too complicated, too busy? So I will probably enter a new one next week, like probably try an SPX delta neutral just to play around with it. And I'll report it back to the group if you like. So and as far as next meeting, I'd like is December 7th. I think that's I know the holiday is getting everybody's way, but do you think it would be better to do like a Saturday, like on a December 7th? And we can do the online version as well. Or we could just do an online and wait till January to do a person. So what do you guys that are here, what do y'all vote? Yeah. Okay. I know it won't work for everyone. There's probably people that couldn't come today, but And we haven't had a live meeting probably, I don't know, since last summer. Mainly because I didn't schedule it's hard to find a room. That's the hardest thing. So if anybody in the Orlando area knows where we could get a good, room, and this isn't bad, it's just, parking is a little bit of a pain, and they don't have a lot of night meetings. I like to do them after the market sometimes, but doesn't always work that way. Yeah.
So can you speak a little bit about the risk management for that trade? I mean, like, if you're buying both, I mean, your risk is fixed.
Right.
So just.
Yeah, so far, I mean, I don't have like
a favorite visit after.
I'm usually like, if it gets within 60 days of my expiration, I want to close it just because theta will start to hurt my long positions. What I found is if you recenter it, that's your risk management. You're kind of like, okay, it's moved up 5 points. Now I move everything. Now I'm totally delta neutral again. So by the recentering, I think that takes care of the risk management. I haven't done it long enough to see like, oh, it's really lost a lot of money, because it really doesn't, because one side offsets the other.
Right. And then for the ones that you're selling, you don't set an exit
I-
on those.
I don't. I watch them and adjust them kind of as I go along. But, certainly wouldn't hurt to have rules. I mean, like one of my kind of rules in general is if I've collected 80 to 90% of the credit, and there's still time left in it, I want to be rolling it because I've gotten all I can get out of that option. Does that make sense? Like say I sold it Friday and now it's only Wednesday and I've gotten 80%. I'll probably think about rolling it out to the next Wednesday for more credit.
I just think that, like, in my mind, so I always try to position to risk, the profit, right? So, like if I'm selling something and it's like 90 cents, that's a 90-cent credit for me. So my exit is going to be at 180.
Right.
So that,
Right.
like,
Yeah, this is a little bit different because you don't want to. What you'll see, especially on the zero DT, it gets up to that your strike, right? But your long call has made money to offset that kind of thing. So, and again, I haven't done a lot of the zero DTE yet, but I would be more cautious on the zero DTE. I'd probably at least go 2 times the move, because you're getting, if you sold it 5 days, you're getting credit 5 days as opposed to 1 day. So, but the weeklies is what I started out doing, and I'll continue to do them because they're really nice little trades. It's just like every week you collect credit for the put and the call. And when you recenter it, you're capturing some of that credit of the move one way or the other. One thing I have found that when it moves down, recentering it ends up costing me a little, versus when it goes up, I tend to make a credit. Any future topics that you guys would like to see? Any strategies that let's see. So, okay. One of the topics that I saw a video on that I just totally was interested in was the double calendar strategy. Have y'all ever seen that or done any of those? Would y'all want to try to do something a little different? Would that be interesting, or would you have something else? Dennis is going to do the double count. Hedging. Okay. Yeah. Yeah. I've come to the conclusion that I do not like hedging anymore. I've never had great luck in hedging. When
how do you protect yourself?
Well, I just exit like before the election, I went to pretty much all cash for the most part. Yeah. So
You chicken shit.
I know. I told you I'm a wimp when it comes to risk, and I worked in insurance my whole life, so I'm always about the minimizing risk. But anyway, I hope this has been helpful, and thanks everybody for being online. I hope it worked out okay. I'll try to figure out this camera thing. I don't know if you that's probably a plus for you guys anyway. So, but anyways, great having you guys on. If you want a copy of the slides, just send me a note with your email and I will send the slides to you. And anybody here, if you just write your email, I'll send the slides to you if you want them. So I'm going to stop the share now. And I'm going to stop the recording. I'll do that first before I. Okay.